Hello, good morning, or good afternoon, depending on where in the country you are. This is Jack Mannon, Director of Brand Marketing for Builders FirstSource. And I want to say thank you, everyone, for taking time out of your day to join the last Builders FirstSource and Zonda Market Intelligence webinar for home building of 2025. Joining Ali today is going to be Jeff Reddig, our VP of Supply Chain, as well as Dennis Candelora, our Senior Vice President of Digital Adoption. Before we get into it, a few housekeeping things. As usual, if you have any questions, there will be a designated Q&A portion of the presentation at the end, so feel free to use the chat function on your screens, and we'll catch up to those at the end. And as always, just a quick reminder, today's presentation may include forward-looking statements, so basically any comments about what we expect or plan for the future. Obviously, actual results can differ, so please refer to our SEC filings for the full list of risk factors. Now, before we begin here, I want to play a video to tee Dennis up here, and it's regarding our myBLDR, our project management hub.
Meet myBLDR, the free digital project hub from Builders FirstSource. It's a secure platform where builders and trades can share plans, track changes, and stay in sync, all in one place. With real-time updates and dedicated support included, you'll spend less time chasing information and more time getting the job done. Simple, clear, and built for collaboration. That's the myBLDR advantage.
I now have the pleasure of introducing Dennis Candelora.
Thank you, Jack. Appreciate the intro. Appreciate the short video. Welcome, everybody. Always great to be here. Great to be here with Ali. Super excited to hear her comments around what's going on in the world these days as it relates to our industry. We are in obviously some very challenging times, so her insight is always great to hear. I would also like to just welcome all of our veterans that are joining us here and say thank you for your service. Happy Veterans Day. I know we have a lot of veterans probably on the call or those that we know, so big shout out to all of our vets. So as we get going here, just kind of some thoughts on where the myBLDR platform can come in today's environment. So when we set out several years ago building out this platform, our goal really was to create a portal, a platform that was a single source of truth for both internal BFS users and, more importantly, our external customers. We wanted a spot where we could have document storage, orders could be processed, quotes could be prepared and shared with customers. Customers could access their delivery schedules, their delivery histories, their order histories, where they could pay their bills, see their statements, and really collaborate with BFS to make doing business with us easier, hoping to drive your cost down and your efficiencies up. And over the past several years, BFS has invested a tremendous amount of money in streamlining that platform and making it very usable for our customers. We continue to adapt and make changes and integrate it into our other technologies, all of our ERP systems. We're in the process of rolling out SAP as a single ERP to our entire company, so we're integrating it with that. And then we're also leveraging a lot of AI tools that will tie into the myBLDR platform to make things more efficient and to really supercharge, what we're going to be offering there. So really the take-home message that we want you to think about when it comes to myBLDR is this is a free platform with one login where you can load up all of your plans, request quotes, access your information, collaborate with your BFS sales rep or inside sales rep, and do business much easier with BFS. And we are in the process, we have some small customer focus groups, but one of the things that we're going to be doing as we go forward into 2026 is expanding our customer focus groups. We're going to be reaching out to folks that are using the platform and gaining valuable insights so that we can make it better for you and we can enhance it. We brought on a new president of technology, Gayatri, about 4 or 5 months ago, and she's just been really supercharging our tech stack as it relates to myBLDR and some of our other digital tools that we're working on. So we'll be a lot more to come on that, but I think the myBLDR platform has been a staple for a lot of our customers to date. We're looking to take it to that next level with the adoption from our external customers. So we We invite you to go on, log into myBLDR. Signing up and registering is super easy. That's all you're going to need is some basic info from an invoice or a monthly statement to just kind of validate your identity and get signed in, and then you'll have access to all of the tools and features that you have. And if there's something on there that you need some help with, please reach out to your OSRs. We've built out a pretty robust support system in the field. Every market now has a digital product specialist that is there to help support our customers and train them if needed on this tool. So we encourage you to utilize those resources. So with that, I'm going to turn this over to Jeff Reddick, give us an update from a supply chain standpoint.
Hey, thanks, Dennis. Hey, everybody. As Dennis kind of mentioned, it is kind of a strange environment, I think, out there for everybody. But in our current environment, lead times are pretty darn normal, and inventory across the supply chain is pretty well positioned. As is normal this time of the year, we are starting to see some manufacturers announce 26 price increases, primarily around cost of living adjustments. For categories that we feel like are still moving around a little bit, like millwork, we're utilizing our global supply partners in sourcing products like finger jointed moldings and boards, while the tariff situation in Brazil continues to play out. This goes for MDF products as well. We've seen quite a bit around the news around tariffs, and waiting, I think we're all see what the Supreme Court says around it. But right now, the countervailing duties and Section 232 duty announcements have not really had a meaningful impact on wood products on pricing today. Lumber prices are largely flat as demand remains soft, and curtailments have been insufficient to help impact pricing so far. OSP pricing has also been flat. It's just curtailments have been insufficient to offset the weak demand out there. As we move into 26, we do expect curtailments and shutdowns to play a role in lumber market pricing. Tariffs and duties have increased the cost of Canadian production, and as demand returns, higher prices and volatility are expected to come to the market. Some of the things currently that BFS is focused on internally is we're working with our partners out there, helping forecast upcoming needs so that they can ensure we have the products to meet your needs in the marketplace. When pricing is being impacted by tariffs, we're asking for verification as what tariff is driving that change and to what extent. And as always, BFS is looking for alternative and viable solutions across the globe to ensure that we have the best products for your project. In time, we do expect to see price increases in other products if demand starts to run up to production capabilities. Thanks, everybody, and looking forward to see what Allie Wolf has to say for us. So, Allie, let's turn it over to you. Allie's the chief economist at Zonda. Allie?
Awesome. Thanks, Jeff. And hello, everyone. I am delighted to be here to again go through the state of the housing market and wider economy. As mentioned, I am Allie Wolf. I'm the chief economist for Zonda and New Home Source. In case you aren't overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Zonda is our B2B side of the business, but we also have New Home Source, which is our B2C. New Home Source is the #1 destination for new home shoppers where they can look for new homes. And for us, because we have this website, we can look for what consumers are looking for. What are they looking to purchase today by home size, by location, by product type. Within my role at Zonda, I lead our economics department, which includes all of our published research reports. Our most popular report is called National Outlook, that is focused on the big picture trends that are happening across the economy and housing market in top metros. We also have a report focused on building products, and coming in just 7 days, we have a new report coming out called our Apartment Outlook. So it's everything you need to know about what's happening in the multifamily side of the industry. Now, we are together today, or at least I have 40 minutes of planned remarks where I have a pretty ambitious agenda. We're going to get through 6 sections. Section 1 and 2 are the here and now. Just what do we know about the market backdrop? 3, 4, and 5 is, okay, let's get past some of this uncertainty, some of this choppiness. What are we seeing with basic fundamentals, the drivers behind why someone might need to purchase a home? We'll look at the labor market, longer term trends, migration, and demographics. and then we'll finish with our forecasts and final thoughts. Now, this first section does start off very high level. It seems almost like it doesn't apply to our day-to-day business, but you will see how this filters into mortgage interest rates, the 10-year treasury yield, and how it fuels into overall housing demand. Now remember, this is very basic. In the 1970s, Congress said to the Federal Reserve, your policy should be enacted in order to work towards maximum employment and price stability. And as the Federal Reserve looks at their two sides of the mandate right now, they're seeing problems with each. But the problem is, to be able to fix their two challenges, the solutions counteract each other. Let me explain what I mean. So one thing we have to acknowledge is that the labor market is slowing across the country. We see this in government data. If you don't trust that, look at the private data. It still tells you a similar story. That in general, we're seeing slowing levels of hiring across the country. In particular, a lot of companies are not backfilling vacated positions. For our industry specifically, what we need to pay attention to is high income job growth. This kind of job growth will fuel housing demand because these kind of workers are more likely to purchase a home. The way you view this map, the darker the dot, the higher the employment growth. So right now, while overall we are still adding jobs, 50% of top markets are shedding high income jobs. You will look for those with the lighter purple dot. The 50% that are still adding jobs, you can see pretty much concentrated in North Carolina, South Carolina, and a little bit across the Midwest and Northeast. Now, if we believe that the labor market is slowing and that the Federal Reserve needs to do something about it, what that means is they should cut rates. They should cut rates quickly because this will help drive more business investment. This will help drive more spending. This will help fuel the overall job market. The complication here is if the Fed were to cut rates very quickly and that started to fuel a much stronger economy, typically a stronger economy corresponds with higher levels of inflation. And this is the other challenge that the Federal Reserve is dealing with today. Now remember, inflation is not where prices are. Inflation is the change in price levels. So you don't want to see the change in price levels be too high, in particular above wage growth, because then quality of life is not improving. Generally speaking, the Fed wants the inflation rate at about 2%. You can see that we've been nowhere near 2% since the start of the pandemic, and we've actually seen the trend more up versus down. So not even seeing that sign that we're getting closer to 2%. If we believe that inflation is our biggest issue, well, then the Federal Reserve should keep rates higher for longer. Complication is we're seeing it play out right now. When you hold rates in restrictive territory for a longer point in time, it does sour business investment. It slows the overall economy. There's a second complication though. Remember, for so long, there was the discussion of, well, inflation is high because the shelter component is high and that's going to come down. It has come down, but it's still disjointed from reality. And there's a question of, is the Federal Reserve making decisions off of potentially not good data? Throughout all of this year, up until September, what the Federal Reserve said is our number one issue is inflation, and we have to keep interest rates high because of inflation. They changed their tune in September, which carried on into October, where Jay Powell explicitly said the labor market has demonstrated pretty significant downside risks, and that has supported the Federal Reserve now cutting rates 2 times this year. Remember, when the Fed cut rates, they're cutting the federal funds rate, which is different than mortgage rates, and this is an important consideration when I show you mortgage rates on the next slide. But the bank rate, or this interbank lending level, can be used to stimulate the economy. We saw this during the pandemic years. Fed dropped rates to near zero. That was trying to drive growth. By March of 2022, they said, okay, wait, too much growth. We need to start raising rates. We saw 11 short-term rate increases where we got to a stopping point of 5.3% for the federal funds rate. That was comfortably in restrictive territory. That was the Fed putting that policy in place to slow the economy. We've now seen 5 cuts since that terminal rate. So we had 3 last year, 2 this year. 3.9 is our current bank rate. Every time the Fed cuts, we're getting closer to the hypothetical neutral rate, policy that's neither trying to influence the economy one way or another. But where we stand today, still, I would say, in restrictive territory. The Fed meets one more time this year in December, and they have explicitly told us this is not a guarantee that we're going to cut rates. Where most people assumed it was a foregone conclusion the Fed was going to cut in October, because of the government shutdown, because we don't have access to some of our traditional data sets that we rely on to make decisions, the Federal Reserve might be more cautious as we close out the year. But like I said, let's see how this has played into our industry specifically. This is looking at the 30-year fixed rate mortgage. And what I want you to notice is this year in September, before the Federal Reserve cut rates, mortgage interest rates went down to almost 6%. After the Fed cut rates, mortgage interest rates went up. If you look at October, before the Fed cut rates, mortgage interest rates went down. After the Fed cut rates, mortgage interest rates went back up. The key driver for our industry and what makes it so hard to actually accurately forecast mortgage interest rates is its investors. They're saying, okay, we already knew the Fed was going to cut rates. Now we're looking at the economy. Now we're looking at the labor market. We're looking at inflation. We're looking at the government shutdown, and we're trying to figure out how we want to invest our money accordingly. Where we stand is we still don't have enough conviction to change our forecast, where we do think for the foreseeable future, we're still looking at interest rates between 6 and 7%. But the improvement that we've seen is since September, mortgage interest rates have averaged below 6.5%. This is the longest stretch we've seen them at this point since where we were this time last year. Earlier this year, we had interest rates at that 7% level. Moving from 7% to below 6.5% has resulted in an 8 to an 11% improvement in overall purchasing power. So this isn't enough to make housing affordable, but we know that every little movement down helps. Moving from that 7% interest rate to 6.5 has already priced in 2 million more households. If rates were to fall to 6% and hold at that level, we would price in 4 million more households. Now, we've been in regular contact with builders saying, okay, we know that rates have been a little bit bouncy, but in general, they're down. How has this impacted your business? The number one response is that the market is still slow. Number two, consumers seem too spooked by macro conditions. And three, we haven't noticed much of a difference. This, by the way, very much aligns with our research, where we've looked at different points in time where the job market is slower and mortgage interest rates are down. Typically speaking, at first, the labor market wins, meaning people become too uncertain about the backdrop, so they pull back from the housing market. Eventually, with no defined timeline, consumers start to return to the market, which is why our industry does typically grow faster than what you find in other subsets of the economy. Needless to say, though, where we are right now is still in phase one, and it's a really good reminder that when we want consumers to make the largest purchase of their lives, they need to have three conditions that are met. They need to have a reason to buy a home, and a lot of people have that today, whether they're getting married, they're having kids, they're retiring. People need affordability, which has improved. We've seen home prices come down in a lot of instances. We've seen interest rates come down, but still a misalignment between home prices and income, and consumers need confidence. This is what is not there right now. When you look at our consumer confidence index, we are close to the lowest level we've ever had on record. And so it makes sense that a lot of consumers are saying, hey, I want to buy a home, I need to buy a home, but let me just wait a little bit longer. Let's see how this translates into overall sales activity. If you've seen me present, I will almost always start with the existing home market. It represents the largest share of total transactions, and tracking this out monthly can help us capture if there's any kind of key inflection points. So throughout 2025, we were actually selling below 2024 levels. Remember, 2024 was the lowest level for existing home sales in 30 years. The September data did look a little bit better. We're coming in above where we were last year, above 2023. Looks like we're forming that bottom, but obviously we want to see a few more months to feel perfectly confident in that. The difference, though, in the existing home market is, for a while, the narrative was we cannot sell more homes because there's no homes for people to buy. That's not the backdrop anymore. When you look at active listings across the country, the purple is 2025, We now have the highest level of active listings since the start of the pandemic. And every month goes on, we're getting closer and closer to where we were in 2019. Now we actually have 60% of top markets today that have higher levels of inventory versus 2019. Remember, pre-pandemic, we weren't flush with supply. We were talking about supply being tight. So we're not saying that this is a particularly bad, but it definitely captures a shift. It definitely captures that the market feels different and is a lot more competitive than what we're used to. Again, the way you view this, the darker the dot, the higher the change in inventory. These are the same states, so Texas, Florida, Colorado, Arizona, Utah, that have had higher levels of supply. You can see Colorado Springs, 90% more inventory versus pre-pandemic. Somewhere like Austin, Texas, 55% higher levels of supply. From a consumer point of view, there's some relief. Finally, people can negotiate, they can get repairs on the house. It's a very different dynamic, much more buyer friendly than where we were the past handful of years. From a seller point of view, no doubt it's more competitive. And very specifically, what we're hearing from builders is there's people that are saying, hey, maybe I want to buy from a builder because they have an incentive or because they can work with me. But once they go to try to sell their existing home, they're having a harder time selling it as quickly as they expected or for the price that what they wanted. If you look at new home sales, I want you to notice that the dynamic is very different. It looks much healthier than what we found on the existing home market. The purple line is 2025, basically coming in line with 2024. Part of that is because of community count. We've had community count levels anywhere where there are 5 or more units for sale rise now for 10 consecutive months. If you have more actively selling projects, in theory, you should see higher levels of sales. So I think that's why the sales numbers can have a bit of a disconnect with what builders are feeling, because in general, builders do not feel good about what this market looks like. But if you know, at Zonda, we track out the production market, but we also like to say, well, how do sales look adjusted for supply, adjused for seasonality, looking at every market across the country compared to their own 10-year history? What you will find is there's very few pockets of overperforming. South Carolina dominating. We talked about the strong labor market and how the labor market is important for housing demand. I did just meet with builders yesterday in South Carolina, and one of the things they said or recognized is even though it's overperforming, prices are down at least 10% from peak in that market. So builders have had to adjust prices to be able to secure that level. If you look at the West Coast, you do see a higher concentration of underperforming markets. I will tie that to demographics later in this presentation. And you can see the majority of markets right now are coming in as average, with a very important caveat. We are saying, how does sales look compared to what we would expect them to look like? Builders are saying, okay, great, maybe we're hitting that sales level, but it's taking us a lot of time, it's taking us a lot of money, we're having to work really hard with the consumers, our margins are getting tighter to get from here to there. So it's no surprise that when we ask builders just about how the market feels, we still have 70% that are saying the market is slower than expected. And it's really layering in everything that we've talked about, watching what's happening in the jobs market, watching what's happening with policy, watching what's happening with affordability, the fact that consumers have more options. And we are in a market today that is just bound by the fact that consumers have no urgency to make that key decision today. So we've now spent 15 minutes just kind of getting us all up to speed on exactly where we are and how it varies across the country. Like I said, what I wanted to do with most of the rest of my presentation is to now talk about, we know things are bumpy, but what do we know about longer term trends? Because to us, longer term trends give us a better sense of market resilience. What markets do we think are maybe a little bit shaky, a little bit dicey right now, but given some of their core fundamentals, will be able to improve at a maybe faster level or a better level over time? One of the ways that we want to try to identify those markets is looking at not just the here and now, not just the slowing labor market, but what about 10-year growth? Markets that have sustained high levels of improvements in their labor market. Again, the way you view this, the darker the dot, the higher the job growth over that period. To make it easy for you, I pulled out the top 10 markets. So Austin, you'll hear me mention Austin a couple times, but Austin is leading the nation right now with the highest overall job growth. Provo in Utah, we have Lakeland in Florida, Raleigh, North Carolina, and Nashville, Tennessee, rounding out that top 5. Like I said earlier, when we look at overall non-farm payroll, it's helpful. It gives you a sense of growth, but for our industry, we really like to look at that high income job growth. So now still darker the dot, the higher the concentration. Here's your top 10 list. Any of the markets are bolded are markets that showed up in the top 10 for both lists. So if I think about market resiliency, I know Austin does not feel good right now, but with almost 65% high income job growth over the past 10 years, there's a reason that market grew really fast, because the labor market was fueling additional demand. You can also see Charleston, Provo, Orlando, Naples, Lakeland, and Nashville, some of our dominant high income market leaders. There's a couple other ways, though, that we like to look at the labor market, and one is looking at concentration of Fortune 500 headquarters. The reason this is important is if you look at our overall GDP, Fortune 500 companies account for 75% of that. It is a wild number. These are such important companies for our country's success. And what I want you to notice, and this is very interesting to me, is only one market, Dallas, was a repeat of the 2 maps I just showed you. So Dallas was in that top 10 for high income job growth. It wasn't in the top 10 for overall. None of the other markets here were capturing that high level of growth. And that's because before the pandemic, before work from home, these were our established core labor markets across the country. These still, in my opinion, show a lot of resilience, but it does just show how our economic dynamics have changed so much over a short period of time. Now, Dallas making both of the lists is good because Dallas is our largest production market across the country. And if you focus on master plan communities, it's the 2nd largest master plan metro across the country. So you want to see if there's a lot of building, is there a solid labor force? In Dallas's case, absolutely by a long shot. Let's turn to one other way that we like to view the labor market. And this is maybe not focused as much on high income. It's focused more on the manufacturing sector. We saw from both administrations that there was a focus on reshoring and onshoring through the CHIPS Act, through tariffs. They're both trying to accomplish the same thing. There are definitely some domestic winners to this focus, this shift on how we want to be operating on the global scale of things. What this map is showing you is where across the country have we seen the most private sector manufacturing investments. You can see the color coding will show you the industry. The text in the bottom left is going to show you the top 10 markets. And so for me, I would like to watch these markets, say, okay, there's been a lot of money invested here. How does this play into the market? If you use Columbus as an example, Intel has invested lots of money into the Columbus market. There was a lot of housing development that was planned around the new Intel factories, but some of those investment plans have been delayed or scaled back. So there's also a risk to making big investments around this because it's still right now not fully transformed some of these local housing markets. But what I do like to see is when I looked at that top 10 list, you're looking at north, south, east, and west. You're seeing across the country, there's different segments that have been impacted by this policy to try to shift more growth to the US. And as I think about more longer term market resilience, to me, this is one of the factors that I would consider as I look at it. Let's shift to look at migration trends, because we know that the labor market is important for demand drivers, but what about migration? One thing that we have to acknowledge is we are well past peak migration. We saw so many people get up and move during the pandemic times, again, because work from home has enabled a lot of people to shift. Now with the return to office and or hybrid work schedules, you will have a normal flow of people moving. It's just not what we've been used to. In particular, if you're in some of those Southeast areas that have dominated from the migration, not saying it's not going to still occur, it's just not going to feel the same. It's not going to be as aggressive. This data at this point is fairly lagged. This was looking at the most recent data from the census, looking at which areas have had the most net migration. You do find, though, generally the clusters have been more southeast than anywhere else across the country. What this data doesn't fully tell you, and this goes back to the discussion of the here and now versus the longer term. You can see Austin has a dark dot. That's because Austin has been big on migration. You can see a lot of Florida areas have dark dots. Florida was big for in migration. But because those markets grew so much, so fast, infrastructure couldn't keep up, schools couldn't keep up, housing couldn't keep up. And so these are some of the markets that are going through their growing pains here and now. They're going through this rebalancing. Prices are down. There's more standing inventory. But again, if we're thinking longer term resilience, we do still like some of those key markets as ones that will eventually come back because those fundamentals are there. Now, what about international migration? Now, international migration is interesting. The American Enterprise Institute, this is a conservative leaning think tank, they have taken into consideration what some of the federal policies are on with changes to immigration. And they think that this year and or next year, we could see negative international migration. If they're right, that's the lowest sustained level of immigration in over 60 years. Now, I am not here, I am not paid to give my opinion on immigration changes. I'm not going to talk about that at all. All I want to tell you is market exposure. If the reality is we are seeing changes to our immigration levels, which markets might be disproportionately exposed? Here, this is showing you the top markets with the most international migration based on absolute levels. So traditionally speaking, you would imagine New York, the one in the bar is telling you New York is #1 for population. The fact that it's the first bar over is also #1 with the most exposure. So you would usually expect that. Larger population is going to have higher exposure. Miami bucks that trend, so 9th highest for overall population, but 2nd highest exposure. As you look down the list, New York, Miami, these are not huge production markets. Is it going to impact many of us on the call? Probably not that much. The ones that I've dropped the arrow in, these are big production markets. These are markets that we just want to watch closer about not only what could be the longer term impact on supply. Right now, we're not hearing that there's much of an impact on the construction labor force, partly because overall construction is down. More immediately, what we've heard is in some of these markets, because of changes to immigration or just perception of what the market might look like, we've seen the demand from newcomers pull back in new home projects. And we've heard that become an issue with some builders, again, only in some markets. We took the international migration numbers and we said, what if we went across the country and set these numbers to 0? What would the impact be on certain metros across the country? This is not an exhaustive list, but this shows you the couple handful of markets that would ultimately see net migration go from positive to negative in the absence of newcomers. Again, thinking about production markets, DC is a big production market, Orlando is a big production market. Besides that, not a huge impact when you think about our industry, at least when I do that kind of calculation. Now let's finish with the final key demand driver for our industry. We have to know and understand demographics to be able to understand our business. And I want to kick things off with the basics. This is showing you population distribution by demographic cohort. At this point, everyone should know millennials are the largest living generation, baby boomers are the 2nd largest living generation. I want you to notice that red bar. So up until the beginning of this week, what we understood was that the median age of a first-time buyer was 38 years old. And at that point in time, that was the oldest we had ever had on record. We got new data this week that does back that now the median age of the first-time buyer is 40 years old, the oldest on record. You can see a lot of those millennials are still hitting that wave. It kind of becomes a moving target of when are they going to get to that point that they're able to continue to buy homes. Gen Z looks very large, but notice that it's Gen Z and Gen Alpha. So in this case, we're combining a couple cohorts there. So it's a little bit of a misrepresentation. The way I'm going to go through this section is we're going to go baby boomers down to Gen Z, just a quick hit on each, where are they located and what do they care about. So with the baby boomer cohort, 2nd largest group, 11,000 baby boomers and Gen Xers are hitting the traditional retirement age every single day. For us in our industry, this is very important because go back to the three things people need. They need affordability, confidence, and a reason. Retirement is a reason. So with so many people changing their life stage, that does over time impact how many people are looking to change where and how they live. If you look at the baby boomer population distribution across the country, the darker the dot, the higher the concentration. No surprise, it's Florida. You got a lot of baby boomers that are going down south. You can see Tucson's very high on the list. You can see parts of the coastal Carolinas. And then up on the northeast, the focus here is that there's a lot of established 55 plus communities. So people that already live in the Midwest or Northeast find those as some compelling options. The baby boomers are the parents of the millennials, so it's important to pay attention to what the baby boomers want to do with their wealth, because this is the wealthiest generation. And what we know is that the majority of baby boomers are planning to give some or all of their money away while they're still alive, which does become an important support for some potential homeowners to have that bank of mom and dad. In fact, if you look at the 55 to 74-year-old cohort, population distribution across the country, 25%, control of the nation's wealth, 50%. 55 to 74, that does include Gen Xers. So let's move on to the lovingly forgotten generation, who should not be forgotten anymore because the Gen Xers are much more diverse than they have been. We have some Gen Xers that are looking for their move up home. Sometimes it's their first move up. Oftentimes we're talking second move up. They're starting to build that equity. They're looking for something nice in return. We also have some Gen Xers right now that are becoming empty nesters for the first time, and they're looking at what that move down property might look like. When you look at the population distribution of Gen X, notice that it is not just a concentration in Florida. The darker the dot, the higher the concentration. In this case, spread across the country, more so though East Coast and West Coast. And I think this ties back to a lot of the Gen Xers are still working, so they will still be tied to what that employment base is for their living situation. I will talk about ethnic diversity in a few slides, but we do think that we'll see some of that movement down to Florida with Gen X, but we think it's going to be a more varied migration pattern. Nevada, Texas, Tennessee, Washington, basically looking for areas across the country that check one or multiple boxes of lower taxes, reasonable cost of living, or lifestyle, somewhere that someone really wants to live. If you move on to the millennials now are much more Texas West. And remember, we said the West Coast markets are slower today. I think that is because you have a higher concentration of more affordability constrained buyers that over time love that there's a higher concentration in the West. That is good for housing demand. That's good for household formation. Right now, it is causing a challenge in some of those markets. For the millennials, I want you to take everything that you thought you knew about them 10 years ago and throw it out, because millennials did get married. Millennials did have kids. Millennials did move to the suburbs. And millennials now do care about schools. They do care about community amenities. Their life stage is now mirroring what we saw of the older generations. With millennials, know that 50% are still renting. So 50% have not seen the run up in equity. 50% are still very much constrained by that rent versus own math. 50% are still are owning a home right now. And for our industry, I think what becomes important is for a lot of millennials, this is the first time in their lives they found themselves with some kind of wealth, and they almost don't know what to do with it at this point. And so as you think about the millennials, it's okay, what kind of communication or education will be helpful to say, well, if you reset your interest rate, this would be the implications. If you hold your home as a rental, this would be your implications. I think there's a lot of moving parts here when we think about the millennial group. Finishing with Gen Z, they're spread across the country. I think this just aligns with a lot of Gen Z are still tied to a university, and so they will just be all over the nation. At a pretty reasonable or equal distribution. I've bracketed out here a lot more so as you just go across the middle part of the country. With Gen Z, they consume information differently. They don't want to be sold on things. They just want easy to understand jargon to help them feel comfortable with the home buying process. Overwhelmingly, Gen Z want to own homes. They've told us that early on, but Gen Z are also staying put in their rentals at record rates. If you track out renewals at rental communities, they are very high. If you look at the percent of people moving out to buy homes in rental communities, that's very low. So for the Gen Z, while they are enthusiastic prospective home buyers, what I'm struggling with is how they will eventually overcome these affordability challenges. A few other considerations that impact overall housing demand, housing design, is just looking at our top buyers. So number one is married couples. Number two, single ladies. Single ladies, yes, they often want to have a lower maintenance lifestyle. Safety is important, but think about their needs, their overall square footage needs. It's not going to be that high as previous generations where you had more people that were married couples or individuals that were living with children under 18. I had mentioned diversity. 72% of baby boomers are white. That drops down to 60% for Gen X. You're almost on par 50-50 with the millennials. As we think about where the market is going, we're no longer talking about a homogenous group. We've heard some of the big public builders explicitly say on their earnings calls, the types of buyers that they're selling to today look very different than the types of buyers that they've sold to in the past. And that has implications for how large is the home? Does the home have certain characteristics that fit different types of ethnic groups? As you think about other considerations, the one I want to talk about too is tied to the idea of single ladies. We do also have more households that do not have children, so we have smaller household in general. Those would be dinks, dual income, no kids, which does also play into household formation and what people are looking for. As I move into my final section here, I haven't spent much time talking about the remodeling space. I went through it in more detail the last time we met. But remember that Todd Tomalak is our remodeling expert here at Zonda. Every quarter through his building product outlook report, he does put out new forecasts. So he put out a new forecast on November 3rd. I'll give you just some of the highlights from what he said. So as he looks at building products, he breaks out the investments or the change in growth from those that go into repair and remodel versus those that go into new construction. You can see on the top, repair and remodel from his forecast are anticipated to grow first. This is showing you the change in spending year over year. So Todd does see an improvement of about 5.8% in spending in 2026 versus 2025. That is a downward revision from his original forecast, but still captures that inflection point, that point of change. You can see as Todd looks at 2027, he calls for even more growth, going up about 9% in 27 versus 2026. He does think this gets tied down to deferrals. There were a lot of projects that were likely going to get done this year, but with the uncertainty related to the tariffs, there were more deferrals that got played out, but he does think will eventually get unlocked. When Todd looks at the new construction revenue growth, you can see for 2026 here, he's calling for a decline of 4.7% in 2026 versus 2025. That's partly because the environment that we're in right now is that overall housing starts are coming in slower, and that dollarizes into the first quarter of next year. So we can see how that's going to just pull down the overall 2026 level. Todd again calls for a lot of growth as he goes into 2027, calling for about 9% compared to where we were in 2026. Todd does believe that there's a lot of uncertainty in today's market, a lot of things that we need to work through over the next, let's say, 9-12 months. He does think, though, that we're going to see more clarity and more stability in the years ahead, which become important for being able to unlock some of those deferred changes. One of the big changes that I think is not getting enough attention is that come next year, about spring of next year, Jay Powell's term as our Federal Reserve Chairman is going to lapse, and we're going to get a new Fed chair. By all accounts, our understanding is that there is going to be some kind of pressure to lower short-term interest rates. So we talked earlier about the federal funds rate. We know that the new Fed chair could move those rates down, get us to neutral, get us to stimulative territory. One of the unknowns I have here goes back to why we talked about the difference between what the Fed does and what the market does. Because you want the markets to buy the vision of the Fed chairman. If not, the Fed could be lowering rates, but you still don't see the 10-year Treasury yield or the 30-year fixed rate mortgage come down. to me, we need to see some clarity on that before we feel really good and have good conviction about what interest rates might look like. We talked earlier that, okay, the data is still not great from an existing home point of view, but have we hit that bottom? Or we're going to see these numbers move up? I think as we move into next year, we'll have a lot more evidence of which direction it's going to go. We at Zonda, we had originally called for bottom this year in existing home sales. Maybe that's playing out towards the end of the year, but I think we're still anticipating that bottom is forming, and we'll see at least a modest lift as we move into next year. And Todd has talked a lot about the idea of how many new accounts have been opened for home equity, but not been tapped yet. There's still just this question of the deferrals have been happening and have been consistent for years. At what point do those deferrals unleash? Again, we think if there are more existing home sales, if we do see more stability, that does help fuel some of that higher level of investment into remodeling projects. If we turn to the building community, most of you know when Zonda forecasts housing starts, we base it on a quantitative model that looks at macro factors to try to guide where the industry is going. We firmly believe that numbers can only get you so far. You need to know, okay, well, what's happening with builder sentiment? What's happening with land and lot supply? What's happening with home sales? There's just a lot of factors that you will have to qualitatively adjust the forecast with. One of the considerations we have is that 50% of builders do think that starts will be up in 2026 versus 2025. Really, three key reasons behind that. Part of that is base effect. So base effect is the idea that this year starts were so low in a lot of markets that there's just an improvement from bottom. Some of it is hope that consumers, that we do have this pent-up demand. They are going to eventually come back to the market. When is it? A lot of builders think, hey, maybe it is going to be next year. But I had mentioned this earlier, there's also just a lot of focus on community count. So community count, anywhere where there are 5 or more units for sale. Right now, community counts are up 11% compared to last year, but the rise in community counts has not resulted in higher levels of housing starts because builders are pulling back on new spec inventory. As they work through their standing inventory, they're not as aggressive at building that, and so that hasn't fully resulted in any kind of rise or notable lift in housing starts. As we step back and think through our forecast, our National Outlook subscribers will get our forecast report. It's about a 20-page report where we go through our logic of everything. We're delivering that later this month. We basically couldn't get to a place where neither Todd nor myself felt like we had enough conviction to really drive the market or call for a meaningful direction shift in next year. I think we have a lot of a pretty good case we could make that, hey, next year is that inflection point and things look better and we call for this rebound. But I also could, with almost equal probability, tell you this scenario where things get a little bit worse next year. And given that dynamic, we ultimately put single family and multifamily housing starts about flat with where we were this time last year. So with that, Jack, I will turn it to you. I think we still have some time for questions.
Thank you so much, Allie. Let's go ahead and look what we have here. Okay, let's go for Dennis. Dennis, you mentioned earlier that myBLDR doesn't have subscription fees. Does that indeed mean that it is free?
Yes, yes, it is that simple. Any BFS customer that has an account with us, whether it's an AR account, and we even allow cash accounts in there, has the ability to access all of the features in myBLDR. There are some other services in there that you can purchase, such as Home Configure, Render, some of the other kind of advanced 3D digital tools. There's a fee associated with those. But for simply accessing the platform, viewing your orders, requesting a quote, seeing quotes, looking at your delivery photos, all of those things, paying your bill, looking at your invoices, all of those are entirely free to BFS customers.
Excellent. And another one coming in while I have you is just general question. How do I learn more about the myBLDR software or even potentially sign up for it? Do I just call my sales rep or is it something I sign up for myself?
Yeah, so great question. Couple of things. Certainly you can go on to BLDR.com or myBLDR.com and you can, there's the registration process there which can gain you access. But I would always encourage you to reach out to your local sales representative, whether that's an outside sales representative, inside sales representative, or whoever you have the relationship with. at BFS, and they can certainly help you get through that process and guide you along the way, and then point you in the right direction from any training that might be needed, so you get the best value out of the system.
Okay, Jeff, this one. What will it take to see higher lumber and OSB prices? Have you heard anything about announced price increases for individual product categories going into 2026?
Hey, Jack. I'm actually going to turn that over to Matt Lufkin, our VP of Forest Products.
Yeah, good question. I think it depends on the category that you're talking about. When you look at DC ratios across the system, which is demand capacity, we continue to see capacity way higher than the demand can consume. So you couple that up with, the tariffs and everything with ADD and CDD and Section 232, it's basically caused the cost of production at the mills to go up and no price lifts to offset it. So that's basically extremely accelerated a lot of indefinite curtailments we've seen on the lumber side, as well as rolling downtime in OSB. There will be a point in the future, it won't be tomorrow, but there'll be a point where we have an inflection point where demand does come back and capacity has come out, and then we will see more volatility on the upside from a pricing perspective. But it's going to be more of a probably later next year deal.
So if we see housing starts or more curtailments or, gosh forbid, a national event or something like that.
Yep.
Okay. Cool, Jack. What was the second part, Jack?
It was about have you heard about any announced price increases for individual product categories heading into 2026?
We have, as soon as Q4 hits, so October 1st, we usually start seeing some price increases. The siding industry has, the major manufacturers in the siding industry have all announced cost of living adjustments for starting January 1st. So that was usually the first category. Then we'll start seeing others start to trail over the next 6 weeks.
Okay, next one here. I'm seeing 45% tariffs on Canadian lumber in the news. How is that not increasing pricing?
Kind of in the same vein of the original answer. If you actually, it's higher than 45% for some manufacturers. When you added the Section 232 a while back, it added another 10 on top of the ADD and CDD. So again, if you look at Canadian production starting in BC and going west, we've seen a ton of curtailments already over the last year. With prices where they're at, we're going to continue to see those curtailments. Again, where the prices are at, we're even seeing Southern Yellow Pine mills shut down. If you look at offshore import, same thing. The vessels aren't coming on the East Coast as much as they have been. We've seen a reduction of that supply as well. So again, until the supply gets back in balance with the demand piece, prices are going to stay relatively flat from where they are right now.
Okay, last question. What products are being impacted by tariffs?
So far, we've seen increases in the metal category. So steel, so think of fasteners and items like that. We have seen some tariff increases coming out of South America, Brazil. So you would think of moldings, MDF in that. So we're starting to shift our purchases to other parts of the world. So categories like that right now, Jack, that we've seen some increases around tariffs. And I think, as Matt mentioned earlier, if demand starts picking up or getting close to that supply capabilities, that's when I think you'll really start to see some of the other tariffs take hold and affect pricing.
Excellent. Okay, thank you. All right, Allie, are you back in swing of things?
I'm back. Yep.
Okay, here I've gotten this question a couple of times here. What is your reaction to the tweets or social media posts from the administration put out this weekend on the 50-year mortgage?
Yep. So we just wrote a research piece on this that we delivered for clients yesterday. The first thing I would say is I'm delighted that the administration is troubleshooting. They're trying to figure out what they can do. I think everyone on this call knows how bad affordability is, and trying to think through the solutions is really difficult. I would say the 50-year mortgage is not it. This is not going to be the silver bullet. This is actually going to put people in a worse financial place if it were to get implemented. And it sounds like it may not actually get implemented because there's been so much blowback to just so many pundits on the left and the right just saying this is not a good idea. Let me tell you why I think it's not a good idea. On the surface, if you run the monthly payment calculation, someone would save 12% a month on their monthly housing cost. And so from that logic, you're like, great, you know, we want people to be saving more money. We want people to be able to qualify for a home. So that makes sense. What we know historically is the longer the duration of the loan, the higher the interest rate, because the interest rate has to compensate for the risk to the bank or the lender. And so we assumed just a 100 basis points increase on the interest rate versus what you would find for a 30-year fixed rate mortgage. That makes the math go 100% bust. You're no longer saving any money on a monthly basis if the interest rate follows the form that we see across moving from like a 15-year to a 30, for example. The homeowners that took on this loan, if it were available, they would pay at least 90% more in interest over the life of the loan. When you think about why people get a 30-year fixed rate mortgage, it makes sense because during your working years, you're paying down your largest asset. And when you retire, you have your free and clear house. You now have 5 decades of paying off that payment. I talked about how the median age of the first-time buyer is now 40 years old. So if someone buys a home at 40 and they have a 50-year mortgage interest rate, what happens to generational transfer of wealth? What happens if they pass away before that loan is paid off? Plus, it's slower to build equity. So I think it's a lose across the board, but delighted that they're just thinking through what could help.
Terrific. Allie, why don't you pick the last question to answer here from the ones that we've chatted back and forth as we've been going along?
Yeah, I think there's 2 I can knock out in about a second. So one was just diversity. Is that population or those actively looking for a market that is population? So it doesn't have to do with who's actively looking, though. If you talk to, I think Taylor Morrison on their earnings call in their investor report said that they now have a majority non-white buyer. So it is, you can you should fact check me on that, but I'm pretty sure that's what they said. They moved from majority white to majority non-white. So it also does translate into home buying demand. There was also a question on what is considered high income. High income will be 3 sectors of the census data. So it's professional, business services, information, and technology. It's pretty much the industry standard of how you calculate what high income is. That can include individuals that are not high income, and that's not to say education doesn't have high income. It's just the easiest way to cluster that data. The last question that I saw come through is just on H-1B visas and how much should we be paying attention to the changes there? Again, if you are in certain markets of the country, you probably don't care at all about H-1B visas. It's not big enough to impact the housing market. It's not big enough to impact housing demand. If you are in College Station, Texas, Dallas, Texas, Houston, San Jose, Miami, Atlanta, Durham, New York, DC, Boston, Philly, Chicago, those are some of the markets across the country that have the highest exposure to H-1B visas. We know that people that already have access to this type of loans, remember it's a higher income, high skilled visa, they should not have any changes to their existing visa, but we've heard directly from builders that there's people that have H-1B visas that still just don't know for sure that it's going to get renewed. So they either canceled a contract on a new home or have chosen to pause their home buying decision. So that's going to be geography specific of how much any kind of changes to H-1B visa will impact our industry.
Excellent. Thank you, Allie. And we're coming right here to the hour, just like we planned it. I'm now going to turn things over for closing statement from Dennis.
Thanks, Jack. First off, thank you, Jack, for organizing this and moderating it. Very helpful. Always wonderful to have you do this. Thank you to Jeff Reddig and Matt Lufkin from the BFS supply chain team for their expert opinions and knowledge on what's going on that side of the house. Obviously, big shout out and thank you to Allie Wolf for all of her expert insight into what is going on in our crazy world these days. But most importantly, thank you to all of our customers that have joined this call. We appreciate all that you do with BFS. We are honored to be able to serve you and be a business partner with you. We wish everybody happy holidays and hopefully to a great 2026. Thanks so much, all. Have a great day.